Hi CMS, welcome to the session on CMA Part 1, Financial Planning, Performance and Analytics. In this session, we'll discuss about accounts receivable valuation on our balance sheet, measurement, valuation and disclosure of the short-term items, which is accounts receivable here. Before we discuss about accounts receivable, we'll see the treatment of accounts receivable in detail. How do we classify these receivables and how do we treat them in the financial statements? We'll discuss in detail about recognition of receivables, the timing of receivables, which we show in our financial statements, any discounts offered to the customers, what is the type of discount that is offered, trade or cash discount, are there any chances of bad debts, we call them as credit losses, and what is the treatment of the bad debts. Then if the money is required, like say for example if there is a requirement of cash, can we pledge the receivables and get some money, called factoring or direct sale of receivables. So our agenda is to discuss about on all these topics. Let us first of all see that what topics we are going to cover here: the classification of receivables, timing of recognition of receivables in the books, the uncollectibles, is there any bad debt that we expect here, which is also known as credit loss, getting our receivables financed by factoring or sale of receivables. First of all, receivable is an amount that is owed by our customers because we sold the goods on credit, we delivered our services on credit, they owe us. Mostly the trade activities, the receivables are for a period of given a credit for a period of 3 to 4 months, a maximum period of 1 year. When we sell the goods on credit, until we collect the money, the duration can be, or credit period can be around 2 to 3 months or 6 months, max to max 1 year. So how do we recognize this revenue? How do we realize this amount? Recognition is different, realization is different. Recognition, you record income, you record a receivable. Realization, you get money from your receivables. Okay, so now let us classify these receivables into trade receivables, accounts receivables and notes receivables. Remember, the classification depends upon various factors: trade receivables, accounts receivables and notes receivable. Trade receivable is a receivable which arrive not from the trade activities. It is a non-trade activity. Means what? This is not the receivable owed by someone by selling our goods or services. It is from non-trade activities. Like example, we gave a loan to a subsidiary company. We loan to our executives. Okay. We loan to our executives. There is an amount due from our landlord, which is a refundable deposit on our warehouse. We vacating our warehouse. Yeah. It's a purely, we can say, non-sale transaction. Insurance claim, dividend receivable, interest receivable, like this. Yeah. Whereas trade receivable is the receivable from the trade activities. Means what, we sold goods and we gave credit 2 months, 3 months, 6 months. That's a trade receivable. Trade receivable is of two types: accounts receivable and notes receivable. Accounts receivable means we sold goods on credit. We have a formal agreement that the customer will pay after 2 months or 3 months. There is a trust between our company and our customers. So it's like an oral promise. Customer requests the goods, we deliver the goods, customer pays on time as we agreed. It's an open account. Notes receivable is a credit sale, but we'll have some kind of formal agreement that you pay this amount, okay, on certain date, okay, fine, but I want some instrument in my hand now. Yeah, so that may be a promissory note, that may be a check, that may be a bill of exchange. So there is a difference between accounts receivable and notes receivable, but of course both are receivables. Both will be shown under current assets as long as notes receivable is for a period less than a year. Open accounts, accounts receivable. Any written for promise given by the customer, notes receivable. If it is like, say for example, a period, customer gives you a promise which can be encashed in a maximum period of 1 year, we call it as current asset, else we will record it as non-current asset. Non-trade receivables, it is very clear that it is not from trade activities. Okay, also current asset, but it's not from trade activities. Yeah, various examples I provided here: tax refunds, interest receivable, dividend receivable, any insurance claims that are accepted by the insurance company but yet not yet received, deposits, okay, loans given to or subsidiaries or executives, any rental income, yeah, revenues, receivable from non-operating activities. I clearly mentioned here the classification of receivables into non-trade and trade receivables. Have a glance on it. Right, so here now let's take an example. A customer A, or regular retail account, buys $18,500 of inventory on standard terms net 30 with no note signed. It's clear that it is a credit transaction and it is for the sale of goods. First of all, it is receivable, accounts receivable, because customer agreed to pay on 30th day from the date of sale. It is accounts receivable. Let's see the second example. Customer B, placing a large customer order, signs a formal $210,000 note bearing 7% interest that is due in 12 months. Yeah, it is also a receivable. It is a trade receivable, but it is a notes receivable because we have got an instrument in our hand. This instrument we can deposit on the due date with the bank. We can encash it. We have an instrument, written promise. So it becomes what? Notes receivable. Let's take one more example here. Meridian Home Goods loaned to an executive which will be repaid in 6 months. One of your executives asked some financial support which you gave him. So loans to executive, loans to subsidiaries are also receivables, but they are non-trade receivables. Hope it is clear. So while reading the questions on the exam date, so please be careful that what is trade receivable, what is non-trade receivable, whether receivable is current or non-current. Mostly the trade receivables are interest free, credit extended to creditors. But sometimes in case of notes receivable, we may add some interest amount. Yep. Let's take an example here. Bramwell Office Supplies Co. delivers goods to a customer who verbally, oral promise, agrees to pay within 45 days. No written notice signed. How should Bramwell classify this receivable? So what we understand here, it is a receivable, it is open account, oral promise, so it becomes what? Yes, accounts receivable. Which of the following is the broadest term encompassing both open account and formally documented claims arising from a company's ordinary sale of goods? It's an open account. Means what? Credit terms. Open account means credit. But it is formally documented. Some instrument is there in your hand. Okay. So if it is a receivable, it is a trade receivable, and you have some instrument, it becomes what? Trade receivable. Also notes receivable. We'll take one more example. Halden Equipment Partners accepts a signed interest-bearing promissory note from a customer to whom we sold goods earlier for a large custom order due in 18 months. How many months? 18 months. So our threshold is 12 months to become a current receivable, to treat it as current asset. How should Alden classify this receivable on its balance sheet? Current or non-current? Non-current. 18 months, more than 12 months. Yep, super. Now let us discuss about discounts offered to our customers. Business organizations offer discounts to customers to induce buy more. Okay, the next discount is like to pay the earliest possible. So based on this, we classify the discounts into trade discount and cash discount. Trade discount is a discount which is offered at the time of sale, inducing the customer to buy in a good quantities. Mostly a trade discount is reduced from the catalog price itself. Reduced from catalog price itself, only net amount is recorded in the books of accounts. Yeah. So trade discount is not recorded in the books of accounts. It is just adjusted in the invoice itself. Cash discount is a discount which is offered to the customer, okay, inducing them to pay early or promptly. Cash discount is to be recorded in the books. Discount allowed. This goes to profit and loss account, income statement. It's an expense. So trade discount we never record in books. It is adjusted in the books of accounts. Invoice. And cash discount is adjusted in the books of accounts. Now let's see an example on trade discount and cash discount. We sold goods worth $10,000 with a 20% trade discount. Means what? The trade discount is adjusted in the invoice itself. There's a list price of $100,000, and because we are happy with the customer, he took a large amount of goods and we offered him 20% discount. The net invoice amount is $80,000. Customer has to pay only $80,000. So our accountant will record $80,000 in the books, not $100,000 and $20,000. The invoice net amount is recorded. Accounts receivable debit, sales account credit. Accounts receivable debit, sales account credit. So never $100,000 and $20,000 will appear in accounts. Only $80,000 will be recorded. The cash discount. We want our customer to pay on regular dates, promptly or early if possible. So we give him some terms called, say, 2 of 10 net 30, which means we are offering a 2% discount if the customer pays within 10 days from the invoice date. January 1st is the sale date. Within 10 days from January 1st. On Jan 10th or before that, when a customer pays, we offer him 2% discount, which means for every $100 of invoice, we will collect 98 and knock off his account for $100. We will bear the risk of $2. Yeah, 2% discount if paid within 10 days. Else, customer will forego a discount of $2 for every $100 of invoice when he pays any day between 11th and 30th day. That is credit period. If it is like a 3 of 15 net 45 means what, 3% discount if customer pays within 15 days. Else 16th day to 45th day he will forego discount. You'll have to pay full amount. So it depends upon the agreement we offer these credit terms. Here in this example 2 of 10 net 30 means 2% discount will be offered if customer pays late, else customer will forego a discount. We forfeit the discount. Then how to record this discount amount? Whether we are sure that the customers will definitely come and pay the amount and collect the discount, or we are not sure. We have thousands of customers. Some customers avail discount, some customers pay after discount period, so they are ready to lose discount. So companies use different methods when they offer cash discounts. Say for example, we are maintaining gross method, which means we record full amount. Only when customer turns within the discount period, we will offer discount. We record full amount initially. We are not sure that whether the customer will turn or not. Yeah, but net method is not like that. We expect that the customer will definitely come within the discount period. So we reduce the amount and record it net amount. When the customer comes, already net amount is there, so we'll just write an entry. But what happens if the customer doesn't turn within the discount period? So you'll need to adjust the discount which was given in the early at the time of pricing an invoice. So that is a discount forfeited. So this is little tedious as compared to gross method. Therefore, most of the companies do not encourage this method, net method. So gross method here, let's take the same example, $100,000 of invoice, 20% already we offer discount, that is trade discount. Our accountant has recorded 80,000, that is accounts receivable debit 80,000, sales account credit 80,000. Also we are offering credit terms to our customer that if customer turns in within 10 days, we'll offer him 2% discount, else he can pay full amount on 30th day. So if at all he pays this amount within 10 days from the date of invoice, we are offering a discount of $1,600, which is 2% of 80,000. So effectively we'll receive 80,000 minus 1,600. When we use gross method, the entry on the date of sale, accounts receivable debit, sales account credit 80,000. So we are not sure whether the customer will avail discount or not. Therefore, we recorded at full amount. No customer turned in 10 days time. Yeah, we have to offer him discount. Cash account debit, discount allowed account credit. Cash account debit 78,400 and we offered him a discount of 1,600. We knocked off his account. This is a gross method. What happens if the customer doesn't turn up? We'll get full amount. First entry will remain same. Second entry will be for 80,000 because he paid this money after discount period. So gross method is very clear. If he comes within the discount period, we allow him discount. No, then we'll collect full amount. Now what is the treatment in the net method? In net method, we expect that the customer is going to definitely pay this amount. So we write net amount, same like a trade discount. I recorded here accounts receivable debit, sales account credit 78,400 because I'm sure that the customer will come and pay this amount. Yes, customer came on 10th day and he paid 78,400 cash account debit accounts. This is very clear. But what happens if the customer does not turn? So in that case, as we recorded initially when the invoice was raised, we recorded at 78,400. Now the discount is forfeited. The amount of discount, we need to add it. So 11th day itself, we will notify a customer that your discount is forfeited and your amount is going to be 80,000, not 78,400 anymore. So cash account debit, accounts receivable credit, discount forfeited. This is an income to company, our company, 1,600. A little tedious as compared to gross method, but few companies may record net method if they expect that all the customers definitely pay within the discount period. Right. So if you have comparison side by side, gross method and net method, it is gross method we record invoice value, whereas net method we record net value, expecting that the discount can be claimed by the customer. Discount taken, yes, allowed. Here no extra entry, only when discount is not taken by him by not paying, on the within the discount period, we will write one more entry. Discount lost, no entry in gross method, easy. But here net method we need to reverse the discount which is allowed. Assumes the customer will not take the discount, but in the case of net method we are sure that the customer will definitely take discount. Very common in practice is gross method, very rare is net method. We don't encourage net method. A quick recap on what we discussed so far: trade discount, cash discount, gross method, net method. Hope you understand. We'll see you in the next session on the different topics in accounts receivable. Till then, have a good time. See you.